The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
Good morning, everyone. Welcome to the Investor Resources October market update. Right off the top here, I'd like to bring your attention to on the screen is the address to our YouTube channel. The Investor Resources YouTube channel is live. You can get to that by going to youtube.com/@IRIradio. We're adding a couple of new podcasts a week on there. And that's going to be a good place to stay in touch. If you were a radio listener back in the day, you're going to get a taste of what we used to do. It's all about what's ever going on in the financial markets right now and things we find interesting about investing. So that is live and being added to weekly. So that's a good place for you to stay in touch and get some updates about what it is that we're looking at these days. As always, on your screen, there's a question pane. If you get any questions during the presentation, feel free to enter them whenever they come up. We have a dedicated part of the show where we're going to go through all the questions that get asked this morning, but you don't have to wait till then to put them in. You can enter them whenever you'd like, so you don't lose track of them. So put those in on the question pane on your on-screen control panel. Okay, let's kick this off here. Okay, this morning we're going to talk a little bit about compound returns. Are compound market returns a myth? During every bull market, pretty much every single one, inevitably there's going to be a retelling of this myth that was really contrived to make sure that Wall Street can take money out of your hands and put it back into their hands, which is, as far as they're concerned, that's the correct place for it. However, the compound market returns number you see, those long-term market returns, is really built on the myth that markets always go up. Therefore, it's always a good time to buy, and that's what Wall Street's message is. Is it a good time to buy? Yes, it is. Now is the time. They have many ways that they put that message forward. This is one of them, the compound return myth. How often have you seen this chart? It's 120 years. You would have made 10% return. This is the one that really they really try to hold us up, and it's a true statement. Over a very long term, stocks have returned roughly about 6% from capital appreciation and about 4% from dividends on a nominal basis, meaning without inflation. But inflation's averaged about 2.3% over that same period. So the real returns are roughly somewhere around 8% long-term return in the market. The obvious problem with this statement is that you do not have, as in this chart, 123 years to invest, unless you're one of the ones that have discovered the secret to eternal life, or of course, with forks being so close, you could be a vampire from Twilight. Otherwise, for the rest of us mere mortals, time really matters. How much time you have to invest is a key, and it's one of the biggest drawbacks to trying to believe in a compound market return. How long do you have to retirement? We get asked that question so often, and people ask us that question when they're coming to us about retirement, and the majority of folks, they'll tell you they have about 15 years until retirement. That's when they're really getting serious. Retirement's looking them right in the face. And so, what happened? Advisors are always talking about the 30 or 40 years you have to compound your returns. But think about that for a second. In most people's lives, you don't really start getting serious for retirement until if you're lucky, you're in your mid 40s. Because by that time, you had a chance to get out of college, you got a good job, you got married, you have children, you get them off to college, and then there's a real push towards saving for retirement. Before that, you haven't reached peak income. It's really tough to put money aside. Your money is caught up in being a parent and living life. So that leaves most individuals, if they're fortunate, with 20 to 25 productive working years before retirement. That's how long most people have to hit their retirement goals. So let's look at this chart and talk about starting valuations. Again, when you retire makes a big difference. Market returns are at the 0 point for many periods throughout market history. And those periods usually are a result of reversion to the mean, it's called, from previous overvaluations. And if you take a look at this, here we have 26 years back from just after 1900, there's no return on the market. Dropped way down, came back up, zero net return. Here we are again, 1929, Great Depression, 29 years, zero return on the S&P 500. 23 years, mid 60s to the mid 80s, same thing. And here we are in the late 90s and the tech boom collapse. 14 years on the S&P, it was even longer on the NASDAQ, just to break even, no return. So what should be very evident is that when you start your investing journey, it's incredibly important to your future outcomes. And that leads us right into those compound market returns. When you're looking at only 123 years, if you started if you retired here in the late 60s, you spent 23 years making no money. That'll blow a pretty big hole in a retirement plan that's built on, I'm going to make 8% a year every year for the rest of my life. When that doesn't occur, your plan does not work, and most advisors don't ever have this in the plan. There's no time period like this in your future as far as they're concerned, because it's much harder to explain. They don't want to talk about that in the first place.
Barry, let me jump in here. So when you're looking at that 70s period and the market's going
Sure.
down like that, and we had those significant bear market drawdowns,
Sure, big ones.
investors don't want to put money in the market. They're sitting there looking and saying, this doesn't make any sense. So
Yep.
Wall Street responds to that, say, if we can't get the money in the market, let's do something else. And so they, in that period, they found that they could sell limited partnerships, which actually
Right.
were much more profitable for Wall Street than selling stocks, even though commissions were still regulated at the time. And today we see the same thing, that instead of limited partnerships, it's alternative investing. Get alternative investment products. Well, those have more costs for the investor. So Wall Street responds to investor psychology. If you don't want to buy stocks, we'll find something else to put your money in. Whether it's the right thing to do or not is irrelevant. The business of Wall Street is to hoover up cash from whoever has it.
And so if traditional investing is doing this, if you're having one of these periods, Wall Street's going to invent new products and new ways for you to invest your money. Oh, that's not working right now. Well, so here's what you should be doing instead. And like you said, Don, it's just so important to remember, anytime Wall Street's pitching anything, it's always just a sales pitch. It doesn't mean it's going to do you any good. But that's, like you said, Don, that's their job. Their job is to turn what's in your wallet into their commissions. That's what they're there for. It's just important to keep that in mind all the time. Albert Einstein, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Well, it's important to notice that Einstein said interest, compound interest, not market returns. And financial advisors, Wall Street, the media, they latched onto this quote to promote the idea that dollar cost averaging into the stock market, in other words, long-term buy and hold, well, that's the answer. That's what you should be doing. But here's the problem. Compound interest and compound market returns, as we just took a look at, they're two different things. Einstein was correct, of course, but most of the time he was. If you buy an investment like a bond or a CD that pays interest, the money compounds over time, every time. And that's because the interest payments are fixed and the principal is returned at maturity. However, the stock market does not provide a fixed annual rate of return, as we all know. It's very variable, and that variability impacts the ending return of an investment over time significantly. Let's take a look at exactly how much. This chart shows an investment in the stock market over time versus a compound market rate of 8% over the same time period. So the black line is the actual market returns. Here's how much your $1,000 investment would turn into versus just a compound 8% annual rate of return, significantly more. This red is showing the difference. It's $42,000 less in market returns than if you actually got the compound market return of 8% every year. It's a huge difference between that average return, which is a fairy tale that they're going to tell you, and what actually happens in the market. And the difference really has everything to do with math. It's so consistent that there's rules written about it. This one is the rule of 72. This is from a firm called Visual Capitalist. They put out a lot of great charts. They're talking about the rule of 72. It's a classic shortcut to tell you about how long it takes to double your money. And the math is extremely simple. If you take any rate of return, let's go back to our 8%. Here it is. You divide that into 72, and it tells you how long it'll take to double. 9 years. If you have an 8% return, your money's going to double in 9 years. If you have a 20% return, 3.5 years. If you get a 2% return, it's going to double in 35 years. So it's very easy to see what kind of a return, what kind of a return you're going to get on your investment if you had an absolutely constant rate of return, which is what, that's the fairy tale that Wall Street puts out. And the math, of course, works. If you put in $10,000 at 8%, you get out there 9 years, and your money is doubled. It's gone from $10,000 to $20,000. It's going to double in 9 years. The problem is, of course, that's only if you make 8% every year and you never have any losses. The losses are really what changes the equation completely. It changes drastically if you introduce negative years. This is looking at the impact of a single loss or two significant losses, or maybe just a single market crash, like the dot-com crash or a 2008 financial crisis, on the time it will take to double your money. If you get the one loss, you got one loss, now you're back on track again, it's going to take you 11 years to double your money instead of 9. If you get two, so you recovered, you lost again, now it's going to take you almost 14 years to double your money. And then if you have a big market crash like the tech bust or the great financial crisis, now you're out there 17 years, just short of 17 years to double your money. So the planning and what they say is coming up in your future is not even close to what actually happens. And like Don just brought up, they're going to invent 16 other products that you should buy instead, because they know this is coming. Some version of this is coming in all of our futures. It's always out there. It's always coming up. And so if you just do what they do, you buy and hold and you stay invested, you're spending a lot of time just making up for the big loss. This time is all just spent trying to get back to where you started before the loss occurred. So you spend so much time it becomes very, very difficult to hit your goals. But the investment community's promotion of buy and hold, it's pretty understandable. It's very easy. It makes them money on all the fees they charge. It keeps the money invested. And given that most of the time, more times than not, statistically, markets go up more often than they fall, it's an easy story to sell. But it should be clear that compound interest is very powerful, but compound market returns just don't exist. There's too many variables, there's too many down years. So those numbers are always thrown out there about making 8% over the long term. No one does that. No one has 120 years to leave their money in the market. So those returns just don't occur in anyone's portfolio. The real world damage that market declines inflict on investors hoping to get that 8% return is real. It really does impact what happens to your portfolio. And when investors lose money in the market, it is possible to regain the lost principal given enough time. However, most importantly, what can never be recovered is the lost time between today and retirement. Time is exceptionally finite for all of us. And in investing, it's the most precious commodity investors have. They'll tell you what we need to look at mostly is the rate of return. What's even more important is how much time do I have left before I retire? Because I'm going to get these markets. The up markets will take care of themselves. What do we do about this? That's the problem. And the thing that you need to realize that these down markets, these drawdowns in the markets, those are not a bug in the system. Those are a feature. That's how this works, and it's all got to do with reversion to the mean. Um, it's how it happens, and that's why it's so important to focus on loss. That's the real risk in the market. When you're looking at risk in the market, it's important that to look at it in real terms of that means what can I lose? And it all has to do with mean reversion again. The mean, the average return of the market is just going to keep running along, but your actual returns are going to keep going up and down. And at these points of market inflection, we've talked about this before, that's where you're going to get the highest volatility. At the bottom when it starts to turn up, at the top when it begins to turn down. But what's going on usually is that it's just returning to the mean. It's a mean reversion. This part we like when it's coming back up. We've already taken a big hit. Hopefully we're going to ride that back up. But up here, when we have the gains built in, we've got them in the portfolio, it's also going to draw it down. And these are the ones that really hurt. And you can kind of watch that happen in the market. And over time, you need to look at not the peaks and the valleys, but you kind of look at where it smooths out a little more, and you can kind of see what's kind of that average rate of return in there that we can expect, rather than looking at the highs and the lows, which are almost never going to stay around in the portfolio. But this is the big risk to your portfolio. It's also the risk of staying invested. This is where people bail out and stay out, and that's when you can really hurt yourself long term. So what are some things to really think about here to take away from this? One is your life expectancy just plays a huge role in future outcomes. How long is your money going to have to work for you? That's a really huge key. And as that changes, so must your expectations about what your goals are. Your life expectancy is something that, of course, is variable. It changes, with your health and accidents and all kinds of things. But take a look at your family history. If grandpa's doing pretty good at 103 and grandma's 106, well, you're probably going to get out there a ways, and so you're going to have longer to invest, and that's good. But don't necessarily bank on that as an absolute given. But that's going to really affect what you can expect from the stock market. Drawdowns from portfolios during declining market environments, that accelerates your principal bleed, your burn, how fast you're going to move through money. Because as the market declines, your share prices go down, and you have to take out more shares to fill your need for income during those years. So in the up years, you got to put some of that aside. Set some of that aside for those down years when it's coming. Don't just say, hey, it's been a great year, let's spend more. You're going to have to let that, you're going to have to have some buffer in there to let that average out, because when you're expecting those downturns, when they come, it's not such a big shock, and you're not so worried about it. You know you're going to recover, but you've already covered yourself because you kept some of the stuff from the good years. And investors really need to just dismiss the expectations for compound annual rate of returns. Instead, you need to really expect variable rates. Expect variable rates every year, and count on some bear markets, and maybe even a market crash during your investment life. They're coming. They're gonna show up in all of our investment lives, and it's important to be ready for them, and don't let it throw you off your game. That's one of the most important things. Never let a bear market take you out of good positions to be in, whatever those might be. Never act out of fear, and that's what tends to happen when a bear market shows up. People get scared and they do things they wouldn't normally do. So you want to understand those bear markets. Don't fear them. Over the last 2 decades, we've had 2 massive bear markets. It's left many individual investors further away from retirement than they ever imagined. The myth of compound market returns is dangerous to individuals who are trying to save and invest their way to retirement. You're going to save less because you think you're going to make much more on your market returns, because it's going to be just a consistent 8% from now until I retire. It's not going to happen. It's really easy to just ignore the fact that bear markets happen, but we need to understand that they will happen. They're going to happen. They're always out there, and they're not always something that we know when they're coming. As much as we look at markets and look at trends and try to figure out what's going on, no one knows when a bear market's actually going to set in and where it's going to come from. Bear markets matter. They matter much more than you think, and they really need to get paid attention to, and you need to build those in to your plans going forward, because they're going to hit all of us. It's just a matter of when and not if. And with that, Don, I'm going to turn this back over to you and let you get into some market data for what's going on currently.
So thank you, Perry. And part of
Yep.
the issue with these bear markets is that there is no planning software that accommodates it.
They don't even look at it. That's true.
What you've illustrated here is straight line returns. And whenever you're doing a retirement plan or a plan for college spending for your kids, the forecast for it assumes you're going to get some given rate of return, and it usually defaults to somewhere around 8%. And as you just illustrated, that's not reality. Your assumption generally should be much less than that, because you are going to run into these market disruptions that unwind the foundation of the plan. And
correct.
One of the assumptions of the financial advisory business in the industry is that we'll do a financial plan for you, we'll set things up, and then it's basically on autopilot. And that's modern portfolio theory, because modern portfolio theory has no adjustment for bear markets. It's always, you're a long-term investor, 30, 40, 50 years to make this plan work, even though your time frame is shorter. Part of those assumptions, particularly over the last 4 decades, has been that interest rates will continue to fall. We've been in a bond bull market since the early 80s, when Paul Volcker was chairman of the Fed and determined that he was going to have to unwind the inflation. And he changed monetary policy and the way policy was managed by the Fed. Previously, the Fed didn't intervene. It let markets correct imbalances. But since Paul Volcker intervened, and we see that his initial work caused inflation to drop, and then it reverted upwards again. And this is the conundrum that the current Fed is dealing with. They're afraid if they cut interest rates too soon, that they will have to raise them again. So they are being more realistic about what's actually going on with inflation. But as inflation or interest rates continue to fall, that's positive generally for the stock market, but for bond investors. Bond investors benefit from falling interest rates. You think of it as a teeter-totter. We've been through this numerous times over the past several years. When interest rates are rising, that damages your portfolio. So the inverse is true. When interest rates are falling, your portfolio value is going up. So if you're in a modern portfolio theory structure and you are using bonds as your safe haven to mitigate stock market volatility and downside risks to your portfolio, it's time to rethink exactly what you're doing, because the assumption has been rates will continue to fall, inflation will fall. And now we're in a paradigm where we're looking at long-term rates. The 30-year rate on treasuries is now above 5%. The 10-year treasury is almost at 5%. We're in a paradigm that has assumed 0 to 2. We're living in an environment where 5 and higher is likely the new norm. It was the norm back in the 60s and the 70s. In fact, if you go back into the 50s and 60s, municipal bonds, tax-free bonds, paid 0.5%. So zero's not uncommon historically, but the corporate rates are typically in this range where we are now. In fact, corporations are borrowing more money at these 5%, 6%, 7% rates than anybody expected them to do. They're accumulating cash because they obviously expect borrowing later is going to be more expensive. But Perry just showed you the reversion to the mean in his part of the presentation. And what we see here is all these reversions where they have been pointed out in the circles. Rates would get high and then they drop back down. And we've had this long-term trend running through the last 40 years, and we have now broken out of that trend. Reversion to the mean is going to be a significant drop in yield in order to get back to this long-term lower rate. At the current time, the Fed is not making any statement that they have an imminent decision to change the current direction of higher for longer rates. We see that in the 20-year Treasury bond. So when rates are falling, bond values are rising. Now, just like stocks, bonds are volatile. The only reason people don't think stock bonds are volatile is because they don't get reported every day. There's a lot of variations. You can have a 10-year bond issued by different companies and with different terms. So even though the maturity date's the same, the actual value of the bond is different because of credit risk, conditions of the whether it's callable or not, and other contract conditions. So we don't get these reported. And if you see it on your monthly statement from your broker, they're using math to figure out theoretically, academically, what the value of your bond would be. So you only see it from month to month. If you actually went to the market to sell it, you would find that it wouldn't match the amount that was reported on your monthly statement because of the market factors. But here we are with the 20, well, this guy actually goes back to 2007. Excuse me, this is 07. So the 20-year bond was issued back in 03. Interest rates are continuing to fall here. And this is where we ended up with the end of the bull market. And what we have is a 20% drawdown to deal with the new normal, if you will. And just for a little chart education, green, what are called candles. Green candles are days that traded up. Red candles are days the market closed down in this particular security. This dash blue line's a 200-day moving average. As a general rule in the market, if you have something below the 200-day moving average, you are in a bear market. And at the current rate, we are now going to have the third consecutive year of negative returns for the safety factor of most portfolios in the country. Bonds, third year of negative returns, and that's the safety factor in your portfolio if you're using modern portfolio theory. This shows the 3-year return from the peak to the bottom down here, which was Friday, is actually down 50% from the high, from the high close. It was actually intraday, it was even worse. So that's an annual rate of losing 20% a year. That's your safety factor in a modern portfolio structure. Think about that. That's not what you signed up for. So here's total drawdown in Treasury bonds with the ultra long duration bonds have lost now more in percentage terms than stocks did back in the 08-09 great financial crisis. The drawdown in the extended duration, which is a Vanguard fund, is 58%. That's peak to trough loss during the 2007 to 9 market crash was only 56. But bonds are your safety valve, right? Sure they are. So here's the extended duration bond at Vanguard. So for 3.5 years, this is up until October, this is from the peak to October 13. We are actually, I'm on a weekly chart, so it kind of accelerates the date, but we're down 65% or losing 25% a year. So bonds need to be viewed in the same way that stocks do. There are times to be in, there are times to be out. The NASDAQ, this is kind of a horror chart pornography. When we look at equities, this is the NASDAQ 100 and how it's done so far this year. That's the black line right here. And this is pretty similar to 1987 and the Black Monday that occurred in October 13th. It was Monday morning. I remember the shock very well that day. I was a broker, not advisor, and my then partner and I had scheduled, unbeknownst to us what was going to happen, a client meeting for Wednesday. Everybody showed up. Everybody wanted to know what was going on with this drawdown. Now, this is a normalized chart. There's no trickery with the way the numbers have been put together. This is starting at the same point in time and working our way through. This illustration does not prove that the NASDAQ will crash next Monday. Starting points on stock market charts are always arbitrary, and conditions are not always the same. I mean, however, we were dealing with inflation in similarly to the problems that we have with inflation today. The numbers were bigger, but inflation was still a problem. Fed was still trying to figure out what to do. But we look at this correlation, and that can be scary, particularly when, as now, stocks have run into some trouble. Now, real yields are after adjusting for inflation. And from the April low, real yields, according to data on inflation protected treasury securities, are up 150% from April. And these horizontal lines show that this is what was called a breakout. This is a major move upward, and continuing upward is a catalyst for serious damage to gold and to technology and growth stocks, because tech and growth don't typically pay much of a dividend. So the valuation is based on how much gain in your business value is going to occur over the next 5 or 10 years, and what is that worth compared to a safe return today. And when the safe return is high, that means the benchmark is much higher. And if your growth rate and your operating profits don't justify that kind of competitive return, I want a safe return and a premium for taking risk with you. Otherwise, I'm not going to invest in your company. The other thing that happens is we end up with what has been called tantrums. And this chart compares the surge in real yields have reached almost the point that we had the temper tantrum back in 2013. The rise in real yields is really pretty phenomenal and is now comparable to the 13, when the bond market fell out of bed at the merest hint that the Federal Reserve might slowly start to buy fewer bonds each month. Right now, they're trying to offload their bond portfolio. But at this stage, the 10-year TIPS yield has gained almost as much as it had at the same point in 2013. The fear is that the Fed has quit buying bonds, and they've been a major buyer, well, actually since '09, but especially so since 2020. And now they're not a buyer, they're a seller. And the Treasury Department has to issue another $1 trillion worth of bonds this quarter to pay for government spending programs. So that's not just the normal budget, it's everything else that they want to spend on. And we don't have a normal budget, frankly. I mean, that's part of the problem in Congress right now. But if you want a good reason why stocks won't crash, it may come down to corporate earnings. In the US, corporate earnings on a comparison basis to a year before are expected to come in much, much better than they have. Corporate earnings were goosed, if you will, with the excess funding during 2020 and the COVID shutdown, and people had more cash than normal to spend. And so we did all sorts of spending, and there's still a lot of that cash sloshing around in the economic system. So where we are now is that the tough years of adjustment are behind us. And now this year, this quarter, we should begin to see some improvement. But part of the disappointment globally and what is depressing the market is that the Chinese post-COVID reopening of the last 18 months was supposed to add additional demand for services and product. And that has not happened, particularly with their real estate market. And as in the United States, the real estate market has been a major driver of Chinese economic expansion over the last 20 years. Now, unlike the United States, if you don't have buyers for it, the construction quits. That hasn't happened in China. I'm sure most of you know that China has built cities, that's real estate development, where nobody lives. That's a lack of demand. And after the post-COVID problems, they have major real estate developers that are hanging on to any government support they can get to avoid bankruptcy. And the Communist Party doesn't want them going bankrupt because that'll destroy the relationships with many foreign investors. So here we are at this point in the cycle. Consumers have low debt relative to the levels that we had coming out of the great financial crisis. That's a positive. And the fact that they have low debt means they still can spend some money. They have low credit card balances, though if they're going to use them, and they are increasingly unable to pay off the balance every month. Now, it hasn't reached critical levels yet, but it is increasingly expensive to not pay off credit cards, and that's problematic. So at the end of last year, household debt service as a percentage of income was 9.7%, and that's not scary. But we do expect inflation is going to continue edging higher over the next year and a half. And with that, interest rates are not likely to come down until sometime in 2025, and that may well be optimistic. But the optimism here about the markets and earnings is not uniform in any way we look at it. And these charts come from Societe Generale. Their chief quantitative strategist shows this stuff. Earnings expectations have risen steadily for the NASDAQ 100, and that's dominated by the Magnificent Seven, the mega cap financial companies, plus Tesla. Tesla in the market is really priced not as a car company, but as a technology company. But on the Russell 2000, these earnings forecasts are continuing to fall. They may be better than they were last year, but the small companies, the Russell 2000 small cap index, is dominated by companies who do not have easy access to capital. So when they need to borrow money to keep operations going, to try to expand their product line or expand their market share, they don't just run up to Wall Street to JP Morgan or Morgan Stanley and say, we need another $500 million. What's it going to cost us? They often don't get in the door. They don't get a meeting. So they run to regional banks. Regional banks are hurting because of higher interest rates. People have moved money out of the regional banks to more rewarding alternatives for holding their cash. So the regionals have less cash available to lend. They're going to be more careful about who they lend it to. So lending standards are tighter, interest rate is more expensive, capital is less available for these small cap stocks. So their forecast for the small caps is about 25% lower than at the beginning of the year. And that explains part of the problem for investors, again, in modern portfolio theory, who have a portion of their account allocated to small cap stocks because you want to be diversified. Well, what's happened here in August is that these have not been contributing to your portfolio. In fact, this line, which is providing looks like it could provide some support right here, is actually a line that goes all the way back to 2018. It was resistance at that time. Small caps struggled around the 200 moving average, tried to break out in 2020, and then COVID came and it collapsed significantly. It did get a rally for a few months, and then in 21, the rally came to an end, and this became a trading range. And since this year has happened, the trading range has dropped. Here's the 200 moving average. We're back in bear market territory, and small cap stocks are basically for the buy and hold investor. Modern portfolio, I'm a long-term investor. I'm here until I don't know when. There's zero return for the last 5 years. This just confirms what Perry showed you in the first half about what it takes for markets to recover when they run into trouble. On the chart I have here, I've had some discussion with individuals lately about, well, small caps are cheap. Shouldn't I be buying those? In fact, on this morning's Barron's report on Fox Business, that was an issue. Well, yeah, they are cheap. And in fact, they look like they might be a buying opportunity. But what I just showed you on the chart is there have been plenty of buying opportunities, which over the last several years have basically been unwound in the mean reversion process. For us, when we look at this black line says there's a lot of market participation, but prices are falling. High market participation means there's a lot of people that agree with getting out of small cap stocks. The red line says the losers are dominant in the small cap. The number of stocks in the 2000 index that are in negative trends is far greater than the ones that are in positive trends. So if you're a stock miner, you mine data, you're into the details of financial statements, you can find some small cap stocks that are probably doing well and have a good future. And just say that the odds here are pretty tough, which is complicated by the fact that higher interest rates are causing an increase in bankruptcies. Bed Bath & Beyond is one of them that managed to survive the post-COVID deal because of speculation from meme investors who were betting that the company could survive, but most of those investors have now lost money. And this is an expanding problem. This is not something that's new. There are an increasing number of companies that are reporting difficulty with their cash flow, on the verge of having to file for a reorganization before they, and it's a last minute attempt before they go out of business. Well, I just showed you this, so I'll move on. Here's the S&P 500. And so we had a rally today in the market, and the S&P 500 is still above the 200-day moving average, but it's below the 50. And what we find is, even though this rally has occurred over the last few weeks, the participation line is very, very weak. We see that when we take a look at the SPY, the ETF that tracks the S&P 500. So on the selling side of the SPY, we find high participation level. Investors are not yet convinced that this is a buying opportunity. As prices are falling, participation is continuing to rise, and the negative components far outweigh the positive components. It's just simply not a good sign. So when we see a market that has a rally, one of the things that typically is happening is the dark pools are intervening in the market. Since 08, 09, the great financial collapse, the major fund companies don't want to lose you as an investor. They don't want you to panic and sell, because if you take your money out of the mutual funds, they lose revenue. That's logical. So they want to keep you in. So the dark pools, which mostly are major mutual funds and some hedge funds, some major Wall Street firms, they looked at this and basically said, is there something we can do to avoid investor panic so they don't dump our funds? And they figured out that if they bought shares of the major components, so think in the tech area, think Magnificent Seven, your Amazon, your Facebook, now called Meta, Apple, Google, NVIDIA, and Tesla, that if they stepped in and bought those shares because they're major overweight components of the index, they could make the decline less significant, and they could prop it up for a while and let everything else underneath just fall apart based on supply and demand. That's what is happening in the market. That's why the indexes have not represented the devastation that has gone on in the broad market over the last several years. When we were with you last month, these arrows show where we were and where this chart was and what's happened since then. This is the advanced decline line for the S&P 500. The number of stocks that are advancing in price has continued to fall. That's confirmed in this lower panel, and it's confirmed with the MACD indicator that there's continued selling and continued deterioration. Now I showed you and I'm going to run through these quickly. This is the Asbury 6 monitor of the internal market matrix. So this isn't a buy or sell signal. This is a health checkup. It's kind of like going in for your annual physical. What's your weight? What's your blood pressure? What's your oxygen level? Let me listen to your lungs. Let me look in your throat. And basically, how are things doing generally? And now tell us, what's going on. So this is the physical checkup of the market. And what we showed you last month is that we had gone through some very quick major changes. This is good. Everything's normal. not so much. I mean, if something bad's going on, we have to figure it out. And then you get a good day, but it's different, but it's still not healthy. And here we are, we went through these 6 last time, and we ended up right here. And so here we now have, on the 13th of September, we said, well, generally you're getting along okay. This isn't too bad, but we need to pay attention to a few things. And they quickly went away on the 14th, but you must have taken some aspirin or something because it masked a problem. And you're not taking your aspirin anymore, or the medication that the doctor gave you. Things have deteriorated and they've gotten worse on the 21st, and they're there as of Thursday. And I checked, they're still there as of yesterday. So when we look at the watch list that we keep track of from a macro point of view, what's the 30,000 foot picture of the earth look like? Cash is our benchmark, and we use this 30-day average maturity corporate paper as our alternative to cash, because up until recently, cash didn't pay you anything. So we use this because there was some interest to collect. But over the last 21 trading days, only bonds have been outperforming this. Everything else, even in spite of a one-day rally, the general broad indices are still struggling. When we look at sectors, the one-day rally moved communications above our cash benchmark. Prior to Friday, cash was a #1 ranked asset. So a month ago, this was the allocation of our 3 primary portfolios. These are condition adaptive models. We don't use modern portfolio theory. We look at what's going on in the market and we adapt to the current trend. And here's where we are today. The select model is in short-term T-bills, nominal amount of cash. Global has short-term T-bills, US dollar, insurance, short-term energy, and the US dollars here. In dynamic, we have a lot of cash. We have short-term treasuries. We have 6-month corporate paper, and we have an option call income, 5% exposure. This is defensive because we still don't have, other than one day, in which the dominant activity was selling. And that's why earlier I said the dark pools can drive the index up, but the major activity in an up day was unloading positions. We got a green candle and a high activity of selling by the institutions. That's a conflicting statement and doesn't justify saying the bottom's in, let's dump all the cash into high tech. That's a forecast. We don't know the future. Nobody does. We follow the most recent trend, and those trends unfortunately have not been long term and has forced some frequent adaptation in the market. We don't predict, we interpret what is actually happening in the market because markets are dynamic. They're constantly changing. We're never going to be always right. It doesn't mean we will never have losses in a portfolio, but at least we are ready to change when conditions change, instead of just saying, close your eyes. You don't need the money for another 10 or 20 years, so you'll be okay. That's modern portfolio theory. We got burned with it in 2000 tech bubble crash. We got burned with it in the 08, 09 housing market crash. And we said, this doesn't make sense. There's a mistake in the theory. And the theory is you don't need your money when the market's falling. You don't need your money until everything's gone up enough to recover the losses, and then it'll be okay to talk about taking your money out. You have independent other sources, and all you have invested in the market is surplus. And that, unfortunately, is not reality. You can monitor your market account. When I spoke with an individual just a couple of weeks ago, so, and we've told you before, we use tc2000.com software. It's not hard to use, but you need to figure out how to do it, and you must have the discipline to do it systematically once you establish your rules. Rules don't always work with the market, but they eventually will. Rules will work in the short term, as opposed to sitting and praying that it will all be okay in the end. Someone needs to worry and watch. We do that for our clients. You can do this for yourself if you want, or you can hire us. We'd be glad to talk to you about that. If you want a second opinion on your portfolio, it's free. All we need to know is what you own. We'll be glad to put together an analysis from our perspective and share that with you online. You don't even need to come in the office. You're watching us here on the computer. We just show you on your computer, give you a link to do that. But if you have questions, now's the time to raise them. So Perry, I don't know if you've been watching I assume you've been watching for some questions for us now on the Q&A.
Absolutely, we got a few questions. We always get good questions from our people logging in here. We can start off with Bob. He wants to know, how long can we expect a bond bear market to last? I would just like to let you know, Bob, if you do find that out, please give us a call. We would love to know exactly how long that bear market would last. It's just like all markets, when we like Don just said, no one knows the future, and that's true in the market, and it's true in any portion of it. So if you're looking at just bonds or just commodities, just technology, whatever it is, no one ever knows how long a trend's going to stay intact and continue. So you have to be ready to react to what is going on instead of what you think is going to occur. That's the biggest difference between what we do and what the NPT folks do. The pie chart portfolio people just say, well, over long periods of time, we're going to get X return in this sector, so we're just going to own it forever. And there can be extremely long periods of time where that does not work. So
in your chart that you showed earlier on market recoveries, if you go back to the 60 to 80, 86 period, I think on that chart, that was a bond bear market. Interest rates were continuing to rise through the 70s, and they continued to rise until the mid 80s, when Volcker finally managed to break the back, and things turned and rates started turning down with inflation. So that's virtually a 20-year period where the bond market persisted that long.
It could be 20 days or 20 years, and there's no way to know. So making that allocation bet ahead of time really doesn't make any sense. That's why we do what we do now versus the buy and hold process, because you have to acknowledge that you have no idea. If it's a bull market, how long is it going to last? If it's a bear market, how long is it going to last? You don't know. You've got to wait for that to play out. And that does actually, Don, segue right into the next question. Chris wants to know, if stocks and bonds are both going down, where should I be investing?
Well, what we've done is taken a defensive posture. So in the Select and Global portfolio, they are dominantly in short-term treasuries. So that's 90 days or less. And those are generating, well, let's just say somewhere between 4.5% and 5% interest, while we wait for some trend development, for some consolidation to actually bring a more optimistic view into the market. We don't know how long we're going to stay there. In the dynamic portfolio, which is more volatile, shorter term positions, we have a fairly significant exposure to corporate paper out to 6 months. So there's a little more short-term risk, but also a shorter or a higher payout as far as the interest rate's concerned. But that's a market, that's a portfolio that will trade much more often if things aren't working right. What we are facing from an economic standpoint is, will the Fed actually pivot and start reducing rates? The current assumption is that might happen in the latter part of next year, but it might wait until 2025 before that happens. That also is struggling with the assumption that what they've done so far, what the Fed has done so far, is insufficient to unwind inflation. Inflation pushes higher, the Fed is going to push rates higher. So we would not be surprised to see rates go to 6% on short-term treasuries. That is more damage for the bond market, but in a 90-day portfolio, it adjusts quickly, and the rollover, the maturing and replacement of the portfolio allows that interest rate payout to track any additional hike in rates fairly quickly. So that's our alternative to do that. If you're a sophisticated investor, you have a couple other things that you might do in the option market with calls, but that's not the business that we apply, or the strategy we apply for clients. You move into options and you have much different risk profiles. So the correlation of the equity market and the bond market is unusual. Normally they go in opposite directions, which is why bonds are viewed as a safety factor. But in today's market, the dollar is about the only safety factor, and that's attracting money from overseas. As long as the dollar is strong, that's bad for technology. It's bad for growth because it suggests interest rates will remain high. We also see,
which the Fed has said they're going to do, higher for
right,
longer. That's their recent read on what they're going to have to do to combat inflation, and of course that always has a direct effect on what's going on in the market. And mentioning tech there, Don, that segues again right into our. We've got one more question up. Mike wants to know, large cap tech has taken a hit lately. Should I still be holding it?
well, we don't know anything about you and your portfolio and your risk, your objectives, your other capital investment. But I would tell you that even with yesterday's rally, everything is below the 50-day moving average. I say the major indexes. I think maybe Nvidia might still have held in there. I didn't check that just before he went on the program today, but I was doing my end of week report, and the New York Stock Exchange, the Russell are still below their 200-day moving averages. The Dow Jones is still below the 200-day moving average, which is bear market.
Correct.
The S&P is dominated by tech, and obviously the NASDAQ 100 is. But if interest rates stay high, then the future growth ability of those tech companies to bring business expansion in excess of a 6% treasury rate becomes questionable. Are you a long-term investor? If you're a long-term investor and you're assuming you're going to hold it for 20 years, you probably,
that's different.
Yeah, you probably wouldn't be on this broadcast.
but right now in our three portfolios, we don't have any pure tech positions. We had large cap tech. Right now, it's the old risk return question. Right now, there's a bigger chance of more risk in losing more in that position than having a breakout and having it returning to all-time highs right now. So in the risk return equation, not a great place to be right now. That doesn't mean it couldn't rally. It can. But right now, we don't own it because the risk is too high in relation to the potential returns that we see available for it right now. So it's just a risk return question. And in the shorter term, the answer is no, we don't own them. If you don't care about what's going on right now, if you are truly going to hold it for another 20 years, it really doesn't matter. If you think Apple's a winner long term, then you can continue to hold it. But like Don said, we don't know exactly what your time frame is. But even in our select portfolio, which is much broader funds, it's almost like a fund of index funds, we don't own any tech. And in global, which can get much more granular, buying smaller pieces, we don't own any tech. And in dynamic, which is much faster, we don't own tech. So that's where we are right now.
Here's the NASDAQ 100 index, and the black line is a participation line. Are investors actually excited about what's going on? And there's not, the excitement was right here, and that's when prices are falling and participation is leveled off. The component differential of what's rising and what's falling is still dominated by falling issues. You can argue that this is the bottom of a trading range, which it does look like. And if you're betting that this is going to go up from here and there's no more downside, that's your bet. Our position is we want to see some internal market matrix be more supportive, where you, as I said earlier, you don't have to keep taking aspirin to survive it. But right now conditions are that the market's still sick, and you need to understand, if you're in the market, what it is you own and why you own it.
And that was it, Don. That was the final question. The board's clear.
Well, that's a wrap. If you haven't signed up for our YouTube or Spotify podcast, please do so. If you need a link to do that, just drop us an email. There's a brief survey coming to you as we end this presentation. We thank you for being with us. We'll do this again next month on the first Saturday of the month.